For the IRS Interactive Tax Assistant tool that answers the question of whether or not you need to report a transfer or a rollover of an IRA or retirement plan on your tax return. So we'll go over this IRS tool, which basically is an automated way for taxpayers to really kind of get their arms around some of the basic rules that determine whether or not there's a taxable event when it comes to your 401k rollover. So generally speaking, before we get into this tool, we can take a moment to outline a couple of broad kind of basic rules. So when it comes to making a retirement account transfer, like from one IRA to another, there are two ways that you can do this. You can do what's known as a trustee-to-trustee transfer or a direct transfer, in which case, let's imagine that you've got an IRA at Vanguard and you want to put everything into your accounts at Fidelity or Schwab. It doesn't matter. The principles are the same. You would basically get the paperwork that you would familiarize yourself with each of the financial institutions and their rules, what Vanguard would need, for you to transfer assets out, which they're not really going to tell you that, but the company that is receiving the distribution will have plenty of resources to help you figure that out. So generally speaking, and my personal experience, negative experience, has been with Fidelity. They've got a really bad reputation in the industry about being very unconsumer friendly when it comes to transfers out of Fidelity accounts, which makes sense because they really want to they want to remove every way that you have without blocking you, which is illegal, but they want to find every way they can to keep the money for as long as possible. And so I've experienced with financial planning clients a lot of situations where Fidelity just is very unhelpful when it comes to transfers out. So, and there's a number of ways they can do that are beyond the scope of this video. But so you would get the information you need, and then you fill out the paperwork. Usually, in this case, it would be Fidelity's paperwork that would transfer your Vanguard account, and then you can submit the paperwork, and they kind of help take care of the rest. The other aspect is that sometimes taxpayers will request the check issued to them, and then they turn around and are now responsible for depositing it into the new account. And so, depending on the rules, you may experience what's considered a taxable event. That, if if done incorrectly or inadvertently, could probably be very disastrous on your income tax return, specifically if you're talking about a significant balance, like transferring an entire 401k account to an IRA. And, if you've got $500,000 of assets and you think that this isn't going to be a taxable event, and then somehow it happens to be that way for some reason, then you could owe a lot of taxes that year. And if you're under age 59 and a half and don't meet one of the exceptions, you could be susceptible for a 10% early withdrawal penalty. So this tool helps people understand whether or not their transfer or rollover could be taxable. And it's a good tool to help you understand some of the rules that kind of guide taxpayers on the proper transfer or rollover of an IRA or a retirement plan. So let's go through this tool, and then we'll kind of circle back to see what else we need to talk about after we go through this tool a couple of times. So we'll hit the begin button, and this takes us to the Interactive Tax Assistant. where we'll answer a series of questions. And in this case, we're recording this right before the 2023 filing season, which occurs in will occur in January of 2024. So we're going to go the most recent transfer or the most recent tax year, which was 2022. So was the transfer made on or before 2022? So if we answered this, then it would say, hey, this wouldn't be included on your 2022 tax return. This might be an IRA rollover that you thought was for 2022, but it ends up being taxable for 2023. Well, the first rule is if it did not actually occur on or before the 31st of the tax year, then it's not considered to have been in that tax year. So let's back up and let's see what other questions come out when we answer yes. So now we're moving. Now, what kind of retirement account did the distribution come from? So this is where we start kind of thinking about, all right, what would happen if we move money out of my 401k plan? I mean, that's a very common moving money out of a 401k and putting it into an IRA. So was this from a designated Roth account? We'll say no, but you could definitely say yes if that applies to you. What kind of retirement account was it? Well, let's say that we transferred it into a traditional IRA. And we're not asking about the repayment of a COVID related distribution, so we're going to skip that question. We're not going to, this is not related to a birth or adoption repayment. There wasn't any IRS levy involved, and we're not talking about repayment of a disaster distribution. And we're not talking about an inherited IRA. Was this a direct transfer? So let's ask this question. A direct transfer is the distribution of funds from one retirement account paid directly to the other. So that's the type of transfer that I was discussing in our example of Vanguard to Fidelity. So you could have Vanguard send the money directly to Fidelity, deposit it into an IRA. And as long as it goes from an IRA and it's considered a direct transfer or a trustee to trustee transfer, and you never actually touch the check, then it should not be considered a taxable event. So did the amount roll over include any amounts that were previously taxed? Let's just say that they were all non-taxed. It says you do need to include your rollover on your tax return. Although the amount rolled over is a tax-free transaction, it's a reportable event. And then it gives you guidance on how you would do this. So you would write the total amount of your distribution on your pensions and annuities line. You would write the word rollover next to the taxable amount line. So in this event, let's imagine that you rolled over $100,000 from your 401k to your IRA. It's giving you the instructions of exactly how you would do that. You would write $100,000 in that pensions and annuities. You would write 0 next to the taxable amount with the word rollover in it, or your accountant would do that. So in this case, you do report it on your tax return, but it's tax-free, right? So, and the reason you want to report it is because this is going to get reported to the IRS anyway, because your institution, your 401k administrator in this case, is going to report this on Form 1099-R. So you're going to get a Form 1099-R. The IRS will get a Form 1099-R. And if they get a 1099-R that says $100,000 and it's not addressed on your tax return, they're going to come back and ask you about it. So that's why you report it on your tax return, so you never even have to get asked a question. But let's go back and say that this was not a direct transfer. Let's see what happens there. 60-day limit. So this is a 60-day time frame that's set in law that basically says from the day that the funds leave one account, you have to be able to deposit it into another account within 60 days. So if it wasn't completed by the 60th day, what happens? Were you affected by a federally declared disaster area? Well, there's some exceptions to that, right? Um, Although the rollover wasn't completed, did the financial institution receive it? Let's imagine that they did not. Was it a frozen deposit? Oh, what's a frozen deposit? It's a deposit that can't be withdrawn from a financial institution because either it's bankrupt or insolvent, or the state where it's located restricts withdrawals because one or more financial institutions are, you know, bankrupt or insolvent. So let's say no, it wasn't. So uh, you might have a valid reason for missing the 60-day period. So, in this case, the IRS is trying to go through every single possible exception criteria. Let's just say, no, we just missed the ball on this. We're not rolling over a loan offset amount. There we go. So in this case, you don't have a rollover or a transfer. The IRS may waive this 60-day requirement when an event beyond your reasonable control has caused you to exceed it. You have to apply for a waiver, and you have to request IRS permission under either publication 575 or 590-A. If you don't have the waiver, you have a distribution, and if you then rolled over the distribution amount into your IRA, you now have a taxable distribution and an excess IRA contribution. So unlike this is a little bit different format from the other tax assistant tools, but I feel like there's a little bit more information here. So instead of a readout of all the questions that you answered, I'm going to hit this printer friendly format. It looks like you have to hit the printer friendly version to get all the questions, that you asked or that they asked and you answered. So I like this format because it still has this information, but then it seems to have a little bit more detail on, what you did, what you have to do now that you've given these answers. So I'm not going to go through all the different scenarios, but it does give you some reference to the resources where you can really drill down into the specifics of your particular situation. What I would recommend, if you do use this to capture your event, you should first check to make sure that you answer the questions exactly. Like sometimes you hit the wrong button or you misinterpret something. So go back to these questions that you answered with the fine-tooth comb and really think through, make sure you answer these questions appropriately. Like for example, with the account information, the time limits. I mean, these are all questions where the IRS is really kind of checking to see if there's any of the outs that you might have had that apply to your situation. Like for example, if you did have a serious illness in your family, or if you had a fire, like if your house was on fire, there are reasons that the IRS can give you a waiver of this 60-day period, because the tax code allows certain mitigating circumstances to uh, to be an exception criteria for that 60-day rule. So pay attention to that and really make sure that you go back if you need to revisit any of those questions, change the answer. You can use this as a planning tool just so that you can kind of game plan like how you would do a few upcoming distribution from one of your accounts to another. Or a transfer, a rollover is what you would want, not a distribution. So I always print this because once you get to the right answer, you want to print it, keep it in your tax records in case you're audited. So And the other thing about this is that this page has links to all the other ITA tools that the IRS has to offer, and they don't always do that. But this is refreshing because the Interactive Tax Assistant has a lot of tools that you can use to help navigate your particular tax situation. So that's all we have for this video. We have tried to put together a small library of similar videos where we walk through the Interactive Tax Assistant tools. You can check them out on our YouTube channel. We also write lots of articles on tax forms. So if you go to our website, teachmepersonalfinance.com, if there's a particular tax form you have a question about, type it in, and odds are pretty high that we've written an article about it. And if we haven't, please post a comment in the comments section and let me know that you're looking for an article or a video on a particular tax form or a topic. So if you like our articles, please subscribe to our newsletter. And if you like our YouTube channel, please subscribe. We're always welcoming new subscribers, and we're always trying to put out the best content that we can. So if you have any questions or comments, please post them in the comments section. And if there's anything that you would like to hear about, please let me know. Thank you very much and have a great day.